Well, the president has a political agenda. He wants to emphasize how strong the economy is, and he wants rates to stay low so the economy remains strong. Nevertheless, I think the Fed's going to do the right thing, which is continue to get closer to a neutral rate and then probably stop.
Right. Not to relitigate the politics, but do you buy the argument? I mean, he took some shots at the previous president, said this is making his life a lot harder. Does that make sense to you? This
is par for the course for the president, to use a golf metaphor, so I'm not surprised.
Ian Shepherdson, you look at where rates are now, you think there's another hike on the way?
In December.
In December, at least one.
Yeah, it'd be astonishing if they didn't in December. And then next year they keep going.
What is your assumed growth rate at this point?
Well, right now we're growing probably 3, maybe even 3 and a bit. I don't think that's sustainable. We're getting a little sugar rush from the tax cuts, which probably won't last. But the trend is like 2.5, which is fine, and it keeps the unemployment rate falling, and that's why the Fed's hiking. It's really that simple. The Fed doesn't yet think rates are high enough to stabilize the unemployment rate. It's already lower than they would like. And this time next year, it might be 3%, which, would be, in many ways, would be wonderful. But the problem is that the Fed thinks that down the line,
pushing on a string, and the other question becomes the issue of wages, which have moved, but it's still moving gradually. How much do you think that is weighing on them in terms of their thoughts?
Oh, it's the overwhelming important variable for them. They care about wages more than they care about anything else. So right now, we're at roughly 3% wage growth. Now, when Stan Fisher, who was the Fed vice chair until last year, he was asked about this a while ago, and he said 3% is where we want to be, which kind of implies that more than 3% is where they don't want to be. And we're heading to more than 3%, so they feel the need just to be tapping on the brakes.
Gary, I don't get it. What happened with the market reaction yesterday? I mean, I didn't understand what the markets heard that brought yields down.
So, yes, you're right, Becky. I was also surprised at the market's reaction. Here, the Fed comes out. They're going to raise rate 5 times. They can get the Fed funds rate to over 3%. And yet bonds rallied, that's 10s rallied, as well as the 2-year came down. So I think what the market is telling us is they don't think the Fed is going to be able to raise rates 5 times, that they're going to have to stop much sooner than what the Fed likes to think they're going to do.
Why?
Because inflation is well contained. I think even Fed Chairman Powell said it was well anchored. And in 2019, growth probably will come down. The sugar rush from the tax cuts will exacerbate, and growth will be better. Inflation's well anchored. There's really no reason for the Fed to raise rates.
That sounds like a perfect scenario, though.
The Fed has achieved a unique spot in U.S. economic history, if you think about it. We're beyond full employment, and inflation is well anchored at around 2%. This is a nirvana for the financial markets.
But the question, of course, is it looks like a nirvana now, but historically, when everything looks like a nirvana, then it turns out to be something else. We'll be talking about this in 12 or 18 months.
If you take a snapshot of where we are today, it's just great. It's absolutely great. I mean, there's nothing not to like about where we are today. The problem is that you can't. It was very difficult to hold on to this snapshot and play that forward into the future without something changing for the worse from the Fed's perspective. And that's why they're hiking now, is to try and stabilize this growth inflation nexus that we've got in place now. But history tells you that's very difficult. Usually what happens is they overdo it. And when they overdo it, we end up with a recession. I've got to say that that's nowhere near where we are now. But what worries me is that if they are so determined to do what they say they're going to do and they keep raising rates, and eventually markets are going to realize, hey, they're absolutely serious, and then things get messy.
But what I heard from Jay Powell is he's going to be watching inflation. He's going to be watching data points. He's not ready to keep spoon-feeding the markets to tell you, here's what we're doing for the next 18 months, traders.
Yeah,
I mean, that's not a bad situation. You want them to be data dependent.
It's kind of like a throwback to the old Greenspan days, where we just see how things are going. We don't have any sort of fixed view. We've got these forecasts, which of course we didn't have in the Greenspan days.
But they might be worthless.
We might not do it. Yeah, we might not do it. It's a statement of sort of median intent. I don't know. They're concerned, though. The worry is that we've never had this unemployment rate falling towards 3%, and they're very worried that's uncharted territory. They're scared that they wake up one day, hey, that's generated inflation. We didn't see it coming.